All right, that was not quite the start to a 3.5 day week going into the holiday at the end of the Christmas holiday at the end of the week. The supposed Santa Claus rally that we've been talking about for the last week or two appears to have faded a little bit today. As we talk about later in the video, as we got another batch of good news. It seems like every weekend we get a batch of good news, but instead of gapping up, we actually ended up gapping down today. Now we filled in a lot of the gap, but we're going to talk about what that change means. Why did we gap down instead of gapping up like on the other weekends when we had good news? And what does that mean about our expectations going into the end of the year, into next year, where all these sentiment indicators have been so extreme? Could that be the signal that we are starting a little bit of an unwind, a little bit of an intermediate weakness? So I'm going to break that down in today's video, and we're going to take a look at a surprising sectors that have actually been the weakest today that you wouldn't have expected. We're going to talk about how to trade that. So let's go ahead and get started. Today is Monday, December the 21st, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's go ahead and get started and take a look at the market forecast indicator with the S&P 500. Look at that big lower shadow, and that's very bullish. In fact, James Boyd, a former colleague of mine, tweeted this out. That this might be a hammer pattern, right? MC hammer, but keep in mind that a hammer pattern occurs when we are at the bottom of a downward move, right? This is hardly the bottom of a downward move, right? When there's a long lower shadow at the top of a bullish move, then that's not called a hammer pattern. That's actually called a hanging man pattern, right? There's one of the best basketball players ever in history hanging on the rim there. So that's actually the legitimate. So Boyd has to remember that not everything with a lower shadow is a hammer pattern, because normally lower shadow is very, very bullish. Here, get back to the chart here. Very, very bullish. But, and not, when they're at the top of a chart, they're not as bearish as like long upper shadows can be. We were holding that resistance until we finally broke out there. They're not as bearish, but when they're at the top of moves, lower shadows can be bearish. So that's something to keep an eye on. And obviously, the bears were there enough today to be down. We had a bigger range. We gapped down today. The near-term line came down, but didn't come down as much. Obviously, by the end of the day, at the beginning of the day, we were way down. Both these lines were way down. But by the end of the day, the momentum line actually rallied. The near-term line finished back in the upper half of the zone. We still maintain a bullish posture. We still maintain rising long-term market sentiment on the S&P 500. Not as bad of a day on the Russell. The NASDAQ, some, again, lower shadow, but not nearly as much of a lower shadow. We had gapped down a lot further on the NASDAQ, and then finally the Dow Jones. So lower shadow there gives us a little bit of a pause for concern that, again, we've been talking about this idea that we might be a little mature in this run with how extreme these indicators, sentiment indicators are, among other, all the indicators we talked about. So we saw that come to fruition today, even with the good news. I mean, you got a vaccine that's being distributed. You've got a stimulus deal now. You've got an election result that's gone through the Electoral College. We still have a little bit of iffiness on the Senate, but even that's not really a big issue. There's not a binary outcome from that. It's either way. I mean, obviously, if one political party maintains control of all the different, the administration, the executive branch, as well as the legislative branch, then can be some policy differences there. But I don't think the market's really too concerned about that. That's why the VIX is up, but it's not too crazy. So in other words, like, all the good news that's out there is out there now. The market has been pricing in all this good news, right? I mean, we've talked about this before, this idea that the market has essentially priced out COVID. This idea that COVID could really disrupt the economy. Obviously, when we were down here, that was the case. And even into June, there were still some questions about, are we going to get a vaccine? Are we going to get stimulus? How that stimulus is going to, are we going to get another round of stimulus? And all of that. So all those questions, and then the election, of course. Well, all those questions have been answered and then some, to the point where the market has priced out any disruption from COVID. Like, The market has priced in economic recovery. The market has priced in this vaccine. The market has priced in a return to normal, because we are not only back on the normal pace of the last 10 years, and if I were to go back even further, go back to the last 20 years, not only are we on, I mean, look at that. Not only are we back on the normal pace here, where we weren't when we were in the COVID low point, and we're outside of the second standard deviation channel for the 20 years. So the market has basically just priced all of that out. Obviously the chart looks a little bit different here with the log scale. The log scale throws off the linear regression just a little bit, but here it looks like it has it on there. Okay, so I mean, there's no, like, all the good news has been priced in, and we saw that today when the news came out of a new stimulus deal over the weekend. The market rallied initially, as you saw from a futures contract standpoint. We actually started positive on Sunday, but then dropped immediately. Again, it was like a sell the news event, right? And we can see how we dropped in the European session. We rallied in the beginning of the U.S. session up until about the middle of the day, and then we just kind of have gone sideways and have stayed relatively flat and currently in the after hours. So there's not a whole lot of good news left to price in. That's a lot of it has been priced in already. So we see that in this market forecast, and again, considering the extreme sentiment indicators we've seen, it opens us up to the possibility of dark pink shading in a red line, right, where the intermediate line falls back down, the near-term line. So watch that near-term line and see if we fill in this lower shadow. Again, lower shadows at the top of bullish moves are not nearly as bearish as upper shadows are, but they're still bearish. So we're going to kind of watch to see as we fill in this range over the next couple of days, or do we come back up to a new high? I think the former is a more likely scenario rather than the latter. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That lets us know you liked our video today and you want us to do another video again tomorrow. Quick way to give us feedback. If you don't like our videos, of course, you don't have to click on anything. You don't even have to watch. But if you do like our videos and you want to let us know, you can do it right now even while you're watching. Just click that thumbs up icon. We look at that every day. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle here at DavidSettle42. And then join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. Here's our Market Outlook live video. So every day I do the Market Outlook. I do a live video at 3:30 Eastern Time. I review all my old trade ideas that I've posted in these videos. We stay, whenever I make a trade idea, we actually trade it. And then we continue to trade it until we close it. And in these videos, we talk about how we're managing those trades. So if that interests you, and I know it does for a lot of you, because that's one of the most highly requested things I've gotten from you. So that's why we've created this product. All of our premium and our plus subscribers get access to that product, as well as all of our trading rooms. You can see our trading room schedule coming up. Our schedule's you click on our trading rooms link here in the menu to get our schedule. We have a holiday break in the schedule, so just be aware of that. And then come down here, click on this heart. It opens up a new tab. Hit this like button right there. Click on this thumbs up icon on the Facebook post. It brings up another new tab. Click that like button as well. Again, the more you do that, the more people will see our video. You can see that post there. More people can see our video of people who follow our account because it has more engagements. Also, it benefits you because Twitter and Facebook promote content in your timelines, to the top of your timelines, from the accounts that you engage with the most. We try to make it really easy for you to engage with us right here. All right, now let's take a look at the long-term chart, this weekly chart. You can see we have very, very high PPO here. What are we at? 7.63. So if I were, excuse me, here, let's edit this. Again, you can see it. We've continued to move this up from week to week, and it's about as high as it's been. I mean, I have to go back a long ways to get to this level. Maybe we got really close at the beginning of 2011, and then of course in the late 90s we got a little bit higher than this. But needless to say, over the last 20 years, it's the highest we've seen. And you can also see too, the candles are getting really small. So we now have a long upper and a lower shadow. We don't have a higher close yet. We have a lower high. So we need to watch. It's a holiday week. We only have 3.5 days this week, but there's a very good chance that we end up with as high above the 200-day moving average as we are right now, a transition candle that can lead us into something coming into the last week of the year that might be a profit-taking week. For the year. So we'll kind of keep our eyes on that. You can see the Russell 2000 is even more bullish, has gone more parabolic than the S&P, and you can see it's starting to get smaller candles too. And of course the NASDAQ 100, very same thing, just getting smaller candles that are leading towards the transition type candle on the weekly chart. If I take a look at the 3 green arrow chart, for the S&P 500, you can see the MACD and stochastics rolling over. You can see again, the SPY didn't have such a strong move to the upside. And SPY, this is kind of it's had kind of a weird move. It's had that little spike up. The reality is the high point was really at 368.58 here during the day. So keep that in mind, that 368.58 is right about there. So that was the high of the day, not this big tube. It looks like a false print there. Regardless, we closed above the 17-day moving average still, though the MACD and the stochastics is rolling over here. If you take a look at the Bollinger Bands for SPY, we are down into the middle. We haven't broken below the 20-day moving average yet, but we're down into the middle. And I mentioned to you before that IWM has got the bigger, the poorer margin of safety because it's got more room to fall before it finds its support than, say, like the Qs does. When the Qs had the poor margin of safety earlier in September, and now it's got a lot of support. So you look at the difference now between the Qs and what we just saw with the Russell, and then also compare that to what the Qs look like here on September the 2nd, right? So if I were to go back and do a September 2nd chart here, for a year, so we'll go back to September the 3rd of 2019. You can see, something very similar to what we saw in the Russell. Not very much margin of safety here, and that has now since changed as we've gone forward from there and developed a lot of volume support. So whereas the Russell has gone parabolic now since this breakout on November the 9th, so that's how much room back to that November 9th open or close, excuse me. That's where the top of the value area is, and that's where its support level is. And that's a pretty decent distance away from where we're at right now. If I take a look at the DMI and the RSI for the S&P to see what kind of directional movement we're getting, we're still in a relatively positive bullish move. It's skewed a little bit by that long upper shadow. If I take a look at the SPX, which doesn't have that skew, you can see we're the positive index has been kind of diverging here, and now it's rolling over, and the negative index has gone up to its highest level that we've seen in a while. If you take a look at the Russell 2000, which has had a really bullish directional move, you can see how much more it still has to come down and how extreme its move was to begin with. If I take a look at the Ichimoku cloud for the SPX, we're still in a bullish trend. It hasn't been able to really break through to strong levels. It's still kind of moderately strong, and that gap is shrinking between the green line and the blue line. The Russell 2000, however, has. So very, very strong levels, but it has now lost that. We were really, really strong here, and now, depending upon where we end up dropping down to, that can go down to zero very, very quickly. So that's something to keep an eye on in the next day or two as well, to see if we lose the bullish trend, the bullish directional move that we've had by the time we get to the holiday at the end of the week. All right, now let's take a look at the intraday chart, and you can see the move that we had. I mean, we started off down, we went down below last week's low point, the low before that, all the while the low point over here is really moving up to the upside. So disregard that high point. That's not really, and I don't know if they'll end up fixing that print or not. Obviously, you can see that's not the highest point we got to right there. So this high is still our high of the past 4 weeks. And of course, we did make it back above the midpoint of actually, the midpoint of the 4-week range is probably going to be in this area. But we did make it back up above this point of control to the upside. Obviously, very little volume up there, as you can see. So that was a positive. In the rally throughout the day, it was a positive to get back up above that point of control. We obviously did not drop out of the value area. We briefly did, but got back up to the upside. Of course, getting through that, there's not very much volume down there. In fact, if I were to go out further to, like, say 30 days, you can see you get through this little area, this node, there's not very much volume down here. So it's a good thing that we've held up so far. Obviously, the move today was one of the bigger moves that we've seen. It is one of the bigger gaps that we've seen, though still not as big of a gap to the downside. We've seen similar size. We didn't finish. But the range today, that's what really stood out. You can see the range. The volume was picked up after Friday's volume expiration, was quadruple witching volume on Friday. We also had very, very strong volume here today, post expiration. So about 96 million shares. The range was not 16 points. The range, if I were to go to SPX, was more at about 6 points. You can see about six and a half, 6 2/3. So whenever I look at it from this perspective, you have to take this with a grain of salt there. But the volume at 96 million, the range at 6 2/3 points is still pretty high. So it's still a pretty decent range. Those aren't the types of days. Those aren't bullish days, right? That's a volatility day. You can see the VIX jumped up and held the 90% level for a support on the way back down. So keep an eye on this volatility to bounce off this support now and move back up again over the next day or two heading into the holiday. And if that's the case, if we can't break back down by the holiday, then we very well could be getting one of those weeks, end of the year weeks, where there's just a lot of profit taking going into the new year and potentially a new Congress, a new Senate on the first Tuesday of the next year. All right, so just to summarize the technical outlook, obviously we've been very bullish. We've had some extreme sentiment indicators. We've been riding this bullish trend, but we saw today what can happen when you run out of expectations for good news, right? When the expectations turn into actual good news and there's not very much expectations left for more because we've got it all, then we run out of buying momentum, right? We run out of the reasons for the buying, which has been all expectations driven towards these events that have been coming through in the last few weeks. So we saw what happens. We saw not necessarily that there was a catalyst for that today, but just that whenever there is a small catalyst, that it can produce a lot of selling really quickly, especially when we run out of the buyers, and especially when a lot of this call buying, which is produces gamma exposure over the last week especially, now starts to unwind, and that can produce a lot of selling. Market Scholar, we've talked about that in previous trading rooms about the dangers of high gamma exposure and what that can mean whenever this large amount of call buying, this extreme put call ratio can start to unwind itself. So that kind of goes to what we've been talking about, this idea that we're strongly bullish. The reward for more upside is limited, not to zero, but there could be some more upside, even still, but not as much. Very, very limited upside potential and more downside or risk, especially on the Russell 2000. And it seems like we're going to start realizing a lot of that risk now that we've, again, run out of the bullish expectations. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What are you seeing, or what indicators or charts you're looking at that suggest that you're a lot more bullish than I am right now, or that you're a lot more bearish than I am right now? All right, so that leads us to what's driving this price action today. And you can see the parabolic move we've gotten here on IWM, just how it's really extended away from what the S&P 500 is doing, what the NASDAQ was doing. You can see the NASDAQ's parabolic move prior to that. If I were to go out to, let's say, a 9-month chart here, That was the Nasdaq's parabolic move, and you can see the gap it formed there. And now we're getting a gap in small cap. And both of them really continue just to significantly outpace the S&P 500, with the dollar really dropping off. So that's kind of the setup, right? That's the environment that we're in. We're so overbought in these areas and oversold in the short term in the safe haven asset classes. If I just look at today here, I'm going to come down to December the 21st and just look how things performed today. Obviously, we gapped down and went down, led by the developed markets to the downside. And, COVID's really being an issue over in Europe still. But small caps, the Qs, commodities, real estate, all down here. Small cap, EEM as well. And then you can see the rally, and small caps rallied the way to the upside, led the way to the upside. International stocks did not. Of course, their markets largely closed here, in Europe especially, so not a whole lot for them to move up at the end of the day. So they kind of went flat. Commodities stayed down as well, and you can see long-term bonds and the dollar stayed up. To kind of give you an idea of what the movement in the long-term bond index looks like here. Give me 1 second to bring up that chart. Is right here. Let's take a look at how TLT has been doing. It's been more bearish. It's got that dark pink shading and a red line, but you can see how it's kind of flattening out here. If you look at the other side of the coin, the yield, the 10-year yield, on a bullish dark green shading and a green line, and it's kind of running into a wall. Now, that could be an ascending triangle, but you can see it's running kind of into a ceiling, right about just underneath this 1% mark, basically at the highs here of this level. Here we got to 9.5%. We got to a high of about 9.86%. We're at 9.4 right now. So that appears to be the ceiling. That was the previous parabolic move on small cap stocks in June. And now we're near that point again. Of course, TLT is more tied to the 30-year, but same thing, right? We've got this high point here, and we're kind of stalling in that high point as we run out of trend strength. If I look at the trend strength, it's just really gone noisy on the 10-year yield. And TLT, you can see as well, we were so bearish, but we're in a noisy period, which means we're not really moving much of anywhere. The dollar, which has been so bearish, the euro has really taken off to the upside here, to this very strong trend coming off of a very noisy period itself. So a little bit of a breakout pattern after that early September peak. We had this breakout where small caps really took off. Small caps, remember, took off here, and then everything else kind of followed suit finally here. And we're up to new highs, but we're also up to on the euro US dollar, which would be bullish for the euro, bearish for the dollar, but we got these divergences. You can see on the MACD, we got lower highs here with the higher highs. You can also see too on other oscillators like the RSI and the CCI, the divergences we have showing up there as well on both these indicators, with both of them at very, very high levels here. So it opens up the possibility for some strength in the dollar, and that typically is associated with an increase in risk aversion. Not necessarily means that we have to start a new trend, a new bearish trend, right? More likely we just come down to the 23% retracement level, where there's going to be an insane amount of support at that point. Here, let's get rid of this one. There's going to be a lot of support, lots of touches around that area. So that's kind of probably the worst case scenario in any kind of intermediate pullback and risk appetite, which would draw stocks down along with them, and probably more so the small cap index because of its, again, frothier nature than what we see in the large caps. If you take a look at globally how things are going, so let's take a look at the 12 grid for all the biggest economies out there. China's got dark pink shading and red line now. Everything else, you can see how it's all dropped down to that moving average. The yellow line on Russia, everything is coming down. We're still very, very high in these intermediate levels in the 90s, but you can see after being so high up above the moving average on some of these, starting to move our way back to the downside here. Let's do the same analysis on the sector chart, and let's go to the sector comparison first. And you can see again the environment we have going in. Energy was a big winner. Financials have been doing well, and you can see technology, communication services, and then your safe havens down here. If I just look at today alone again, so we'll go custom, come down here to December 21st, and just look at how we did today. Obviously, energy was the biggest loser and ended up being the biggest loser by the end of the day. Financials held up because, again, remember, they got the good news on Friday about buying back shares, not being able to pay dividends yet, but buying back shares, benefiting the sector as a whole. And you can see XLK, obviously, too, didn't go down as much. XLC didn't go down as much. That's why, your QQQ names are going to end up being your better names on any kind of weakness. It'll be your small cap stocks that drop. And even then, it was energy, really. But if you look at staples, utilities, and real estate, they were the biggest losers initially on the day. And then they ended up being the biggest losers. So that's not your typical sell-off. This is not your typical market sell-off when your safe haven sectors ended up being the biggest losers to the downside on the day. Let's take a look at the 12 grid for the sectors. And you can see your cyclical areas up here looking just like all those foreign markets, as well as these other cyclical areas: energy, materials, industrials, financials. But look at utilities and real estate. I mean, they're really lagging behind. Staples has dropped below its moving average. It's the only one that's dropped below its moving average. Healthcare is giving us light pink shading. So interestingly enough, our weakness is in the safe haven areas. So keep that in mind, that if we are going to get any kind of weakness here, it might be more limited to these areas that have done so well over the past few months. They have the most to give back. They have the poorer margin of safety, and the safe havens aren't right now. Doesn't look to be the best bets either. It looks to be the best bets to rotate into is to stay in these cyclical areas that will hold up better. The QQQ names that will not only hold up better during any kind of unwinding of this parabolic move in small caps, but will also probably lead us up after the weakness is over, because you expect the large cap names, when there's such a disparity in sector weightings, to be the ones that lead the bullish moves. You only expect the small sectors to lead in short bursts like we've had, and now that they've lost that leadership, we expect to go back to those large cap names. And that takes us to our trade idea of the day. I want to take a look at a sector that's a stock that's in kind of a market discretionary, but mostly a consumer staple, and that is McDonald's. Right, McDonald's is a staple. It's everybody eats there, and no matter what kind of environment we're in. But as you saw, the safe haven areas aren't doing as well, and McDonald's has actually been in an intermediate pullback for a while now. Dark pink shading and a red line, and we're rolling back over from a new high point here. If you take a look at its three green arrows, we've had three green arrows, but to a lower high, and now we've already got one red arrow. And we're looking like we might get a second one on the stochastics, and the MACD histogram is rolling over as well. You can see what it looks like on the two-line version of that chart. Back below the 8-day moving average, back below the 17-day moving average, with both of them below the 30. MACD rolling over, stochastics not getting above 60. You can see the oscillators here getting above 50, getting above 0, but not getting above 100, not getting above 60, getting above 50, sorry. Not getting above 60, getting above 0, not getting above 100. You look at the DMI here, and you can see we had a bearish move here going. We've had a couple of bearish moves. We've had a bullish bounce, and now we're reversing back, right? The ADX is down low, so we don't have very much of a bearish trend going. And if you look at the Bollinger Bands, we're still gravitating around the point of control at the top of the value area, so there's not a whole lot of downside movement that we have to concern ourselves with too much. Here's the long-term chart. We're just kind of the momentum is dropping as we flirt down with the 200-day moving average and kind of trade in between that gap. So it doesn't lend itself to a significant bearish move, but it does open up the possibility of doing a bear call spread and adding some negative deltas to our active trades. I've been overwhelmingly bullish here lately. So if I were to sell the 217.5, buy the 220, you can see that gives me, for a full position size, about $400 worth of risk or gain. So that's how much I'm willing to lose out of that $1,000. I don't want to lose more than $438. And you can see we're already up a little bit since we got into it during the Market Outlook Live earlier today at 3:30 Eastern. So that's kind of the idea behind that trade, is, again, just taking advantage of weakness in the markets, especially the weakness in the broader areas. You can see the gap down. We did fill in some of the gap, but rolling back over and staying down from this high point that we weren't really able to get to a higher high. We formed a lower high, and now our break even for that bull put bear call spread, is above that high. So if we were to break through and get back up above, fine, we'll take that loss on it. But if we continue to roll over, move to the downside, we might get to our 50% of maximum gain before the end of the week, right? Which we'll, while we're still more than 20 days out, we'll take that and try to do another trade before the 20 days is out. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have about today's video. Reply to other people's questions and comments, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, as well as on Twitter and Facebook too, and comment on our videos. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.